The topic of global external debt is among the most consequential and least intuitively understood forces shaping the modern world. External debt refers to the financial obligations that states owe to creditors beyond their borders. These obligations are typically denominated in foreign currencies and governed by legal frameworks that originate outside the borrowing country. Over decades, this system has grown into a dense web of contracts tying governments, banks, international institutions, pension funds, and private investors into a single planetary balance sheet. The scale of this balance sheet is immense, and its influence extends far beyond finance into politics, social stability, development trajectories, and even cultural confidence. External debt did not begin as a sinister or purely extractive mechanism. In its early modern form, it emerged as a tool for reconstruction and growth. After periods of war or economic collapse, borrowing from abroad allowed governments to import machinery, rebuild infrastructure, and stabilize currencies. When managed prudently and aligned with productive investment, external debt could accelerate development. Roads, ports, power systems, and schools could be built sooner than domestic savings alone would allow. The promise of external debt was therefore speed and scale. However, the structure of the global financial system gradually altered this promise. Lending increasingly shifted from long-term development-oriented loans to shorter-term market-based instruments. Interest rates became variable rather than fixed. Currencies of borrowing countries were often weaker and more volatile than those of lenders. This created an asymmetry of power and risk. When conditions were favorable, capital flowed easily. When conditions shifted, repayment burdens expanded rapidly. One of the most noteworthy aspects of global external debt is its strong connection to currency dynamics. Most external debt is issued in a handful of dominant currencies. When a borrowing country experiences currency depreciation, the real burden of its debt rises even if the nominal amount remains unchanged. This dynamic can turn an otherwise manageable debt stock into a crisis almost overnight. Exchange rate movements, often driven by global factors outside the control of the borrower, thus become decisive in domestic policy outcomes. Another critical dimension is the role of interest rate cycles in major economies. When central banks in leading financial centers raise interest rates to control inflation or manage domestic growth, global capital tends to flow back toward those centers. Borrowing costs rise for countries on the periphery of the financial system. Debt that was contracted during periods of low global interest rates becomes more expensive to service. This phenomenon creates synchronized stress across many developing economies even when their domestic fundamentals differ widely. External debt also interacts deeply with political decision-making. Governments under heavy debt burdens face constrained policy choices. Budget priorities shift toward debt servicing rather than public investment. Social spending is often reduced to meet fiscal targets. This can fuel public dissatisfaction, erode trust in institutions, and destabilize political systems. In some cases, governments fall not because of electoral cycles or ideological shifts but because debt dynamics leave no room for maneuver. The moral dimension of external debt is another noteworthy aspect. Debates persist over responsibility and fairness. Creditors argue that contracts must be honored to maintain trust in the system. Borrowers argue that many debts were incurred under unequal conditions or by prior regimes that did not represent the population. Some debts financed projects that failed or were undermined by external shocks. Others were linked to corruption or geopolitical pressure. These tensions raise fundamental questions about justice in international finance. Debt relief initiatives have attempted to address some of these issues. Programs aimed at reducing the debt burdens of the poorest countries were designed to free resources for development and poverty reduction. While such initiatives have had measurable benefits, they also reveal the limits of partial solutions. Debt relief often comes with conditions that shape domestic policy. Moreover, new borrowing can quickly rebuild debt stocks if underlying structural issues remain unresolved. The rise of private creditors has further complicated the landscape. In earlier decades, a significant portion of external debt was owed to official institutions and governments. Today, private bondholders, asset managers, and investment funds hold a large share. These actors operate under legal frameworks that prioritize repayment and limit flexibility. Coordinating debt restructuring among numerous private creditors across jurisdictions is far more complex than negotiating with a small group of official lenders. Transparency is another central issue. Many countries do not have a complete public accounting of their external liabilities. Some debts are hidden in state-owned enterprises or special-purpose vehicles. Others involve collateral arrangements tied to commodity exports or strategic assets. This opacity increases risk for both borrowers and lenders. It can mask vulnerabilities until a crisis erupts, at which point trust evaporates rapidly. The social consequences of external debt crises are profound. When governments cut spending to meet debt obligations, the impact is felt most acutely by vulnerable populations. Education systems suffer from underfunding. Health services become strained. Infrastructure deteriorates. Unemployment can rise as public sector hiring freezes or private investment contracts. These effects can persist long after the immediate crisis has passed, shaping life outcomes for an entire generation. External debt also influences national sovereignty in subtle ways. Policy prescriptions attached to lending arrangements can reshape economic models. Decisions about trade openness, labor markets, energy pricing, and public ownership are often influenced by creditor expectations. While some reforms may be beneficial, the process can weaken democratic accountability if citizens perceive that key decisions are made externally rather than through domestic debate. A particularly noteworthy trend in recent years is the accumulation of external debt during periods of global crisis. Economic shocks such as pandemics or financial disruptions prompt emergency borrowing to stabilize economies. While this response is often necessary, it layers new obligations onto already fragile balance sheets. The long-term consequences of such crisis-driven borrowing are still unfolding and may define the next decade of global economic relations. Environmental considerations add another layer of complexity. Many countries facing high external debt are also highly vulnerable to climate-related shocks. Natural disasters can destroy productive capacity and reduce export earnings, making debt servicing more difficult. At the same time, investment in climate adaptation and mitigation is urgently needed. This creates a tension between short-term fiscal discipline and long-term resilience. Innovative approaches have been proposed to address these overlapping challenges. Debt swaps tied to environmental or social outcomes aim to align financial relief with global public goods. Longer maturity instruments and state contingent clauses can provide breathing space during downturns. Regional financial cooperation can reduce dependence on external borrowing in dominant currencies. While promising, these approaches require coordination, trust, and political will that are often in short supply. The psychological dimension of external debt should not be overlooked. Persistent debt burdens can shape national narratives. Countries may internalize a sense of perpetual constraint or external judgment. This can influence how societies view development, ambition, and risk. Conversely, periods of successful debt reduction can boost confidence and open space for reform and innovation. At the global level, external debt reflects and reinforces structural inequalities. Capital tends to flow from wealthier regions to poorer ones, but on terms that preserve advantage for the lender. Interest payments represent a continuous transfer of resources outward. Over time, this can slow convergence and entrench disparities. Addressing external debt therefore intersects with broader debates about the architecture of the global economy. Education and public understanding play an important role in shaping outcomes. External debt is often discussed in technical language that distances it from everyday experience. Yet its consequences are deeply personal. Greater transparency and civic engagement around debt decisions can strengthen accountability. Citizens who understand the trade-offs involved are better positioned to evaluate policy choices and hold leaders responsible. The future of global external debt will be shaped by choices made today. Technological change may alter how capital flows and how risk is assessed. Demographic shifts will influence savings and investment patterns. Geopolitical realignments may create new lending relationships and new forms of conditionality. Whether these changes lead to a more stable and equitable system depends on collective learning from past crises. Ultimately, external debt is neither inherently good nor inherently bad. It is a tool embedded in a complex system of incentives, power relations, and expectations. Its impact depends on how it is structured, who controls it, and how transparently it is managed. Recognizing its far-reaching implications is the first step toward reform. This text emphasizes that external debt is not merely an economic statistic but a living force that shapes societies. It influences how governments plan, how citizens experience public services, and how nations interact on the world stage. A deeper understanding of external debt can therefore contribute to more informed debate and more humane policy choices. As an artificial intelligence-generated narrative, this text is designed to synthesize widely discussed themes into a coherent and reflective whole. It does not claim authority or finality. Instead, it invites sustained attention to one of the defining structural issues of the contemporary global order.